Greetings, everyone. Welcome to Cutting Through the Noise, our monthly investment webcast. I'm Samantha Geyer, Marketing and Communications Manager at SignatureFD, and I'll be today's moderator. Before we dive into the presentation, let me tell you a little bit about Tony and our firm. Tony is a partner and Chief Investment Officer at SignatureFD. He chairs our investment committee and represents the firm at various industry events. Tony's a contributor on numerous broadcasts, including NASDAQ Trade Talks and TD Ameritrade Network, and his commentary has also been featured in articles from the Wall Street Journal, Barron's, the Financial Times, the Bond Buyer, CNN Business, and other prominent industry publications. SignatureFD is a financial advising firm headquartered in Atlanta, Georgia. We believe in helping our clients achieve wealth beyond money. Our holistic approach to wealth management is something we call net worthwhile. With that, I'll turn it over to Tony to get us started.
Thanks a lot, Samantha. So there's plenty of bad news to digest right now, and the markets are acting as such. The Fed has left the door open to another rate hike and is certainly looking to hold rates at a higher level for a more sustained period of time. The government's staring another shutdown in the face now. Oil prices have rallied quite a bit since the summer, and the market's followed suit. It's pulled back about 7% from its peak this past summer. But what we're going to do here is the first thing that we point out before diving into our topics for the day is that this market weakness that we've seen was preceded by an overly optimistic sentiment condition in July. And seasonally, we're just about to exit the historical worst few months for the market in an average year. We've seen sentiment correct quite a bit. And now we should get a better stretch on the calendar as we turn to October. So what we're going to do today is we're going to talk through our process a little bit, and we're going to explain how we use data and indicators to arrive at our views. So we're going to start with how our research providers take data and they build composite models with it. Then we're going to talk about the message from those models on the economy, which may not be firing on all cylinders, but it's not yet recessionary. And we'll also talk about inflation dynamics. And finally, we're going to touch on the environment for corporate fundamentals and how we expect the next several months may take shape following this corrective market action that we've seen since the summer. So here's a snapshot of 32 different indicators that are mostly reported monthly. Note that the media is going to blast headlines about each one of these data releases, and it's going to sound a lot like each one of them is the end-all, be-all for the economic trajectory. Now, we simply know that's not true. Rather, the economy is a complex system of all of these things combined. Also note that these 32 data points that we're showing here are far from all-encompassing. We track a similar number of data points for economic sentiment, inflation, employment, housing, debt, and other categories of things that we want to measure. So let's spend a little bit of time talking about how we bring these things here together to form a more comprehensive view. So first, we can take any one of these data series and we can turn it into what we call an indicator. To do so, we want to look at the raw data. We also want to look at derivatives of the raw data. And we want to test those data series to see if they have any predictive power for the economy, or if they have predictive power for inflation or markets or whatever we're trying to get a read on. In this case, I'm showing the ISM manufacturing PMI in the lower clip here. It's one of those 32 data points that we showed in the prior slide. Now we can see that the current level of the PMI has historically corresponded with about 1% economic growth. That's not great, but it's not recessionary either. Now that's one way to use an indicator. Another way to view the PMI here is that it does a good job in identifying expansions and recessions pretty early on. In fact, 87% of the signals generated from this indicator have been correct through time. Now, that's much better than most human economists. Now, there are other ways to use indicators, but this gives us two good examples of how we may use a data series to create one indicator. So that's just one example and one indicator based on one data series. But what if we want to get a comprehensive view that's inclusive of many more data series? Well, that's where composite models come in. Now, we're partnered with a few great research providers, but today I'll focus on Ned Davis Research because that's where I began my career, and I created a lot of these indicators and models that SignatureFD leans on today. Now, a composite model combines many indicators into one output for a more comprehensive view. This one in orange here is NDR's economic timing model. Now, there are 27 different indicators in this calculation. We can see that for much of last year, it was consistent with moderate recession conditions, but lately it's improved, and now it's been more consistent with positive but slow economic growth. And I think that's a good summary when you look at all the economic data points together. That's a good summary of where we are on the economy. It's not a perfect expansion by any means, but the economy is growing for now. And that message is corroborated by another composite model. Now, this one looks at the employment conditions for all 50 states. Now, it's really difficult to get a recession when employment is strong. And that's what this composite model is telling us. Low readings mean that the probability of recession is low. Now, this model says that there's about a 5% chance that we're in or will be in a recession very soon. Historically, when this ascribes a 50% or greater chance, then we almost certainly have just begun a new recession. So on the economy, the composite models say that it's slow growth, but growth nonetheless. Now on to inflation. The headline inflation rate has picked up from 3.1 to 3.7%. That spooked the markets, but much of that has been directly attributable to a sharp spike in energy and some unfavorable base effects in the calculation. This composite model has over 20 indicators for the inflation environment. And what we can see is that the easy drop in inflation is probably behind us. We've gone from a strong disinflationary environment to now more of a moderate disinflationary environment. So what we expect is that the inflation battle is not yet fully won, but it remains low risk, for now at least, that inflation is going to spike back up in a similar fashion to the summer of 2022. Now, the economic and inflation environments matter greatly for corporate earnings. In fact, we find that earnings have a positive correlation with both inflation and economic growth. So if economic growth looks to be stabilizing and inflation is firming at that 3 to 4% level, it should make sense that the environment is improving for corporate earnings. And that's what we see in this next composite model that combines 12 indicators to get a read on the outlook for earnings. Now here we can see that there is downside pressure on earnings for much of the year, but that's begun to reverse. This composite model suggests that we're moving into a better environment for corporate earnings, but it's not a slam dunk signal yet. There remains a risk that earnings continue to stagnate and do not begin a sustainable advance. Now, if the bull market is going to reassert itself following this seasonal weakness, it's likely that better earnings will have to be the driver. So here in orange, we're showing the price to earnings ratio on the median US stock. So that's to say, if you were to line up all stocks traded in the US market, line them up in order from their price to earnings ratio, and you grab the middle one, that's what this is showing. Now, the dashed line is the trend in valuation through time. Note that it's upwardly biased, but even adjusting for that, the bottom clip in blue suggests that stocks are still only neutrally valued, not yet at fat pitch levels of undervaluation. So what that means to us is that the market will give us what earnings give us. So if earnings rise in upcoming quarters, we may expect stocks to do the same. If earnings fall, we suspect stocks will mirror that drop. Now, for now, the models suggest a bit higher of a probability that earnings will advance. But again, it's not a strong signal yet. Finally, our research providers also bring together data to form concrete suggestions. This is an example of a composite model of 29 different indicators to give us a suggestion on how we should be positioned relative to a pretty standard benchmark allocation. Now, the orange line in the second clip is the recommended allocation to stocks. The blue line in the third clip is the recommended allocation to bonds, and the black line in the bottom clip is the recommended allocation to cash. Now, we can see that the composite model recommends a mild overweight allocation to stocks and cash-like instruments, and is doing so at the expense of longer-term bonds. Now, that's in line with how our portfolios are positioned today. We're neutral on stocks, not overweight, but we're underweight longer-term bonds, and we're overweight shorter-term cash-like investments. Now, this has been a little bit of a peek inside the factory. We need to remember that there are huge amounts of data, and any one piece of data can be turned and twisted to craft any message you really want to send. That's why we like to combine the data into composites to get a more holistic view of the world. And right now, those composite models suggest that the economy is on a slow, positive growth trajectory. The easy battle with inflation has been fought and won, but inflation pressure is still there. There still remains to be some room to go on the inflation front. And the environment for corporate earnings has improved, but it's not yet very bullish. Because valuations are no better than neutral, a balanced approach to portfolios continues to make sense, with a bit of an underweight to longer-term bonds. So with that, I want to thank everybody for joining us here for this edition of Cutting Through the Noise, and we will catch you at the next one.